Welcome back, everybody, to episode number 11 of the Wide Lens podcast. I've got Matt Rigby here with me as usual.
Hello all.
And we are recording this on the 7th of April 2022, and we're going to cover the latest topics in financial and investment markets, and we'll kick off with Matt's Mark a Minute.
All right, here we go. So the ASX 300 over the last 5 days, flat, about down 0.7. Year to date, down 2%.
Not a bad result.
Interestingly, one of the better performing markets in the world in the first quarter this year. The NASDAQ down about just under 3% over the last 5 days, down about 9% year to date. Over the last 5 days, Lululemon came out with some pretty good numbers, up 10%. Intuit, which is the accounting software, up about 2.2%. 27 stocks up over the past week. Year to date of the NASDAQ 100, we've got about 47 stocks down more than 10%. That's up slightly from last week, and 22 in positive territory, which is slightly down. Of the, we'll call them cloud security companies. So Okta down 30%, Zscaler down 25%, CrowdStrike up 7%, and Palo Alto Networks up 11%. Just thought it was interesting. I think Okta had a data breach, or one of the clients had a data breach a week or so ago. So they're down a little bit on the back of that. S&P 500 down 2.3 over the last 5 days, down 5% year to date. So not too bad given what happened in the first quarter. Last 5 days, Twitter up 25%. You may have seen Elon Musk bought in and made a crap load of money off that.
He made about $1 billion, didn't he?
Yeah, made $780 million in 1 day.
Yeah.
Absurd. McCormick, the spices company, up about 6%. Ford down about 10.8 over the last week.
Why are they up? More people having barbecues and rubbing spice.
They came up with some good numbers. They weren't great, but they're slow and steady. Everyone's still cooking from home, I think. It's a pandemic hangover, we'll call it. Year to date, about 39% of the S&P 500 is positive. That's 196. 183 down more than 10%. And the retailers, so Costco up about 1.3, Target down about 7, Walmart up, we'll call it 4.5, and Best Buy, the electronics retailer, down about 8.9 for the year. Emerging markets flat over the week and down about 10% year to date.
They're getting worse, aren't they?
It is getting worse, but at a slower rate. Does that make it better?
Yeah. I don't know. I mean, you look at the NASDAQ, you look at the S&P 500, some of those...
They've all bounced.
It bounced right back.
Whereas this is still...
This is going the other way now.
Yeah, still at its low. So it took a while to sort of tip over. Oil down about 2.8 over the last 5 days. Still up about 28% for the year at about $97. So I just did some quick numbers. Oil's down about 25% from its peak, but petrol, based on the pump price I saw this morning, down about 15%, including some of that tax coming out. So
including. So if you strip that out, it wouldn't be down.
Some of those petrol retailers are making more money, I would assume. So come on, guys.
Maybe they haven't maybe the guys have gone to take the numbers out and put the new numbers on the board.
He can't get it off, so it's just staying there. Bitcoin down about 6% over the last 5 days, down about 9% year to date, sitting at $43,473 US dollars.
Oh, you know how we talked last week about was Bitcoin the turning point? It actually was. So look, I was looking at it last night. I was just tying up the doc, and 22nd, 23rd of January, Bitcoin bottomed out.
January? No.
January.
Really?
Yep, January. Bring it up.
Yeah, okay. I will. You keep talking.
Check it out. Run the chart for the last 6 months.
Oh, yeah, it was too.
22nd of January was the bottom.
Yeah,
look, admittingly, we had some rises and falls since then, but 22nd of January was the bottom for Bitcoin. And I also, I haven't run it for risky assets like the S&P 500. S&P 500.
Year to date, its bottom was where? Oh, like March 14?
Yeah.
March 8, 14.
It did bottom out on the 27th of January. It rallied, but then we had a downward trend then right through to March. But Bitcoin was front running all this, and it's been rising since 22nd, 23rd of January. So just for a bit of a laugh, I thought that was
interesting.
Very interesting. That was quite funny. So last week we were talking about, Larry Fink came out talking about the death of globalization.
Yep.
And we were chatting, and I mentioned that I was listening to someone talk about what metric are you going to watch that will tell you that the world has gone from globalized to deglobalized. Mm-hmm. And he was saying that you want to watch Apple, that you want to see Apple moving onshore, or however they're going to start managing their business. That will be the trigger point to verify whether this thing is true or not.
Yep.
Interestingly, I feel like this flies in the face of deglobalization. Bloomberg had an article. Apple weighs more memory chip suppliers, including China. Kioxia mishap may mean more business for rival memory makers. One option is including a Chinese chip maker for the very first time. I'll just quote this from Bloomberg. Apple is exploring new sources of the memory chips that goes into the iPhones, including its first Chinese producer of the critical component, after a disruption at a key Japanese partner exposed the risks of its global supply. Apple remains keen to diversify its network. I think this was a quote from Apple. Apple remains keen to diversify its network and offset the risk of further disruption from the pandemic. What do you think about that? I also, just before you answer that though, I did read in the article that different manufacturers may supply for different versions of the phone. So if you've got the cheaper version, you've got a manufacturer that's in Japan. We've got a Chinese manufacturer. Then you've got Samsung producing this particular chip for this particular phone, etc.
Yep.
I think it'll be a massive win for Chinese companies if they can land that. Yeah. I think there'll be a much higher degree of confidence in. I don't think the confidence lacks there, but I think it'll just be a massive win for Chinese companies doing business with such a large international company. Yeah. Whether that flies in the face of US manufacturing, I don't know. What do you think about that? Do you think that is a deglobalization factor, or do you think this is just BAU for Apple?
I find it interesting that whoever it was you're listening to said watch Apple. I think that's really interesting. As for this move...
Because what else is the metric? What else is the thing that's going to tell you that we've deglobalized?
How do you quantify closing a factory somewhere and opening it somewhere else? No idea. But this move is interesting. Given all the issues China had, obviously COVID starting there, all the shutdowns, they're shutting down again, and it's already impacting Foxconn. So it's interesting that they'd go back there and not look somewhere else, they're in Japan. I don't know. Right. Why not? No idea. Build their own in Texas or California or somewhere. They've already got a lot of supply coming out of China, so they're not doubling up, but they're adding to that. There must be, you could imagine the Chinese government would be viewing this as a big win. Like they could tout that as
100%.
We've got Apple on board, blah, blah, blah. So I can only imagine the size of Apple, the sway that they have, that they must have some sort of certainty or assurances from the Chinese government that if you open this up, we won't shut this down. We know how critical it is. It's got to keep going because, they're shutting down Shanghai and cities of 10, 12, 40 million people. It's shutting them down. So I found that really interesting, and it would be fascinating to know whether it's just for local, like whether that's phones that are produced local or in Asia or for sale in those areas. Forever, I think, or not forever, for quite a while, Apple haven't been the largest seller of phones in China. So does that play into it? Does that open up or give them a stronger, say in that Chinese market or more appeal in that Chinese market if they've got, chips being made locally? Tim Cook's a smart dude. He knows what he's doing. I'm sure all of that is factoring into it.
How do you think the US sort of views this?
As
it relates to
I don't know what
Chinese
the
relations.
chip manufacturing capacity is like in the US. I have a feeling there's one or two factories or manufacturing facilities being built in the US, and they're hideously expensive, like billions of dollars to build one. So I don't know what sort of capacity is onshore there. Apple have been pretty successful in developing their own chips. Obviously, they're not making them. So Yeah, I don't know. I'm sure they'd like to, but yeah, maybe it comes down to cost. Maybe the cost is just that much cheaper in China relative to going to the US. That
Can take that risk.
Yeah.
Worth paying off.
I don't know. What do you think? I don't know. Do you know what manufacturing's like in the US?
No,
For
I mean,
chips?
I was looking more so at it as a, what does this mean for globalization or deglobalization,
Yeah.
more so than which chip manufacturer is going to be helpful to Apple or not. Interestingly, we'll talk a little bit later. Maybe this whole deglobalization is probably not going to go as far as everyone just coming back on shore and starting to manufacture and produce and ship and so forth where they're domiciled. I don't know if it's going to go that extreme, but how much sense does it make when you start diversifying your inputs, right? So instead of it coming from one major manufacturer, you've got one manufacturer inputting for your base model, then you've got for your, I don't know, for your S or for your whatever different versions of the phone you have. To me, that makes a lot more sense than going the other way, whereby your risks are far greater.
Yeah.
If you've got an earthquake in Japan, which disrupts chip making, already we're seeing chips, and we'll talk about it later on, that whole time frame to get chips is not getting any quicker. And so diversifying makes complete sense to me, but it's how do you then manage when one thing goes wrong? Does one chip then fit into the next phone? How do you make sure it's priced properly? Because if you've got a more expensive chip going in a cheaper phone,
It doesn't work.
Yeah, but
Yeah.
I'm sure this has all been thought of.
It's also interesting, we spoke a few weeks ago about all these companies' reactions to Russia and the invading the Ukraine. And I think you posed the question, what if it was China? Would they pull out of China? And China obviously have a lot of stuff going on in human rights, violations and all the rest of it. So
Well, beyond
clearly
that,
it's not Apple's. That's not their concern.
No, it's not.
At this point. I don't know. It is interesting. And from that globalization, it kind of makes sense to regionalize given what we've gone through, but it's an expensive exercise to do that. And you've got to have that capacity and the facilities there or proven skilled workforce to, you can't just open up a chip manufacturing facility in, I don't know, Brazil. You've got to have the skilled workforce and all that sort of stuff. So,
but to your point before about Russia and China, is there not something going on with China? I mean, I'm not keeping up with it all, but are China and Russia maybe not on a similar page with whatever foreign dealings they've got with each other? And if that is the case, then this whole support Russia, don't support Russia thing, I don't know where does it actually stop? But so far, it doesn't look like it's stopping anytime soon as it relates to China.
No.
Let's move on. Just to wrap up on that one, I don't think this whole deglobalization is going to go from a fully globalized world to we are now bringing manufacturing back on shore and everything's a bit controlled here. I think it's somewhere in between.
Yeah, as always. All right, so next one, nowhere to hide. So you may have been aware the first quarter wasn't great. Stocks were down a little bit at one point and came back. But so this article, again from Bloomberg, was just looking at, and there's a chart here which we'll bring up in a second, but it's basically looking at stocks and bonds, what happened during the first quarter, and essentially losing 5% was the best that you could do, whether you're in stocks or whether you're in bonds. That's your best outcome. And then it just got worse from there. So we'll bring up this chart here. So stocks and bond investors just had the toughest quarter in decades. So you can see here on the left-hand side, 1980, the period 1980-84. You can see at the start of 1980 was the, equivalent. It looks like the best you could do at that point was down just a bit over 5%. And here on the right-hand side, 2022, again, stocks and bonds, the best we could do was down just under 5%, not too bad.
We haven't seen that for, as the chart says, since 1980. We have had some late in the mid-90s, and 1, 2, 3, 4, 5, 6 or 7 times in the last 42 years that we've seen this. So it's pretty extraordinary. I was reading the article actually, and it said more than $3 trillion was raised from bond and equity values in the first quarter as the Federal Reserve raised interest rates for the first time since 2018. The question I have is, where the hell did the money go? People report these things like in a puff of smoke, this money just disappeared. Where does the money go? It goes to cash. It has to go somewhere. It can't just be taken away and miraculously disappear into the ether.
Yeah.
It has to go somewhere, right?
Yeah, absolutely. Did it go into crypto? We saw a few weeks ago, I think I had an article where short duration bonds is where a lot of stuff is going, and that's near cash. So they're really short dated, short term bonds. So that you'd call that in the cash basket.
But this is talking about, just having a look, the least bad performance among US assets were declines of 4.9% in the S&P 500 and speculative credit. They were followed by 5.6% fall in treasuries and 7.8% fall in investment grade.
Yeah. I don't know. Is it alternatives? Is it private equity?
Well, put it this way: the money's going. No, I don't think it's going there. I think those inflows have slowed down.
Have they?
But I think there's cash, and it's a matter of time before that cash gets redeployed.
Yeah, well, that was going to be my next point. Is like the waves, tide going out, tide coming back in, cash going out, cash is going to come back in at some point.
The money is not going to sit in cash forever.
No.
Even as the Fed raises rates, what are you going to go from 25 to 50? You're at 75. You're at 1. Do you think people are going to hold cash at a 1% Federal Reserve rate?
I think some will, but it won't be a large portion.
I agree.
Maybe. Well, we've seen for a long time, and we've seen this. People are going, well, I've got X amount of cash. What the hell am I going to do with it? 10 years ago, it was, I've got X amount of cash. I can get a TD at 5%, term deposit 5%, 3%, whatever. It's not great, but it's something. I mean, you can't even get 1%.
But also, even if you get 1%, you've got that group of people that say, well, I'm going to move this money from this puff of smoke that it disappeared from into bonds. Naturally, if you've got that much cash sitting on the sidelines, you're going to have a natural bid on yield, which means there's going to be this. I feel like there'll be this natural limit whereby if you hit 1.5% to 2.5%, the Australian 10-year bonds at 2.5%.
Yep.
And if that's where things are at, I'm confident you'll have investors being pretty happy with a 2.5% yield, and they will bid that yield down. You're not going to be able to raise it much more than that. I don't think.
Yeah, no, I think you're right. And factor inflation into that. So you're getting 1%, inflation's at 4, 3, 4, 5, whatever it is. So you're still losing.
You're still losing money,
but maybe you're losing less.
And so I reckon there will be a reallocation. And look, bonds have had one of the worst years almost on record as well. So the amount of outflows we have been seeing in bonds is insane.
Yeah, and it's clearly not coming back into equity. So it's got to be
for
somewhere.
now. Sitting in cash.
Look out. When it comes back, though, it'll come back hard, I would imagine.
Yeah. I think
you get this don't want to miss out mentality.
I think that's a whole other topic, which I'm sure we will get to at some point. But I wanted to jump onto most expensive property and most expensive assets around the world. Knight Frank had I recently came across their 2022 wealth report. Mm-hmm. This particular one, and I'll bring this infographic up now. It's by Statista, who took the info from Knight Frank, and it looks at the most expensive square meterage of prime property in the world. So prime property, it's not looking at every
piece of property.
Every piece of property, it's
particular city,
and we'll get to it later as to how Knight Frank look at prime. So in Monaco, you can buy 15 square meters of residential property for $1 million. Hong Kong, New York, London, Singapore, Geneva, Sydney's. I didn't think Sydney would be up there, but they're in the top 6. 1, 2, 3, 4, 5, 7, top 7. Let's say the top 10.
Yep.
Shanghai, Paris, Los Angeles, Beijing, Tokyo, Berlin, Miami, Melbourne.
I was surprised by that. I didn't think Melbourne.
Madrid, Mumbai, and so on. What do you think about this? Is the narrative that we hear in the papers all day, every day, as bad as? I mean, they're not even. It's not even the top 10.
Well, it's still
Melbourne.
It's pretty close. I was surprised that Melbourne was up that high. Equally, I was surprised Sydney was that high as well. The Canadian, Vancouver and Toronto, I mean, they were always touted as some of the most expensive property in the world. They've come back down.
Yep.
Chicago, San Francisco. There were a few cities there I was a bit like, oh, okay. What's the narrative? I think for Melbourne, for its size, its location in the world, we're not in a big hub like an Asian hub or European hub, North American, Sydney as well. I think it's expensive, but what do you get for that? You get
84 square metres of prime residential property.
Yeah, but are you in built-up areas? If you've got big towers next to you.
It's prime property. So
define prime.
I don't know how Knight Frank defined prime property, but it's not like
Toorak.
Yeah.
As opposed to
Sure.
What, Williamstown? I don't know.
Yeah, maybe.
Brighton? Don't know. Look, it's interesting. I'd love to see the history of how that has changed relative to other cities over the last
I think Knight Frank might even have that. The way I kind of see it is you can I don't know if you're looking at Asia, especially in Hong Kong, like the living conditions and how people live there versus how someone lives in Melbourne.
Yeah.
Plus, you get you get property that is 4 times the size versus that of Hong Kong. Like, I don't know. It just, the way I see it is, it is what it is. Property around the world has gone bonkers.
Yep.
In the US, here it has gone berserk. I think also there's an element of interest rates just going to zero, which naturally has a correlation to higher debt, which naturally then leads on to higher property prices.
Yep.
And so for those reasons, this doesn't surprise me. If I'm a property bull, what I would say is, well, there's a long way to go for property in Melbourne.
Yeah.
This thing could keep going and you could start buying. The only thing $1 million is going to get you is 50 square metres of prime property.
That's crazy. Would you trade your 84 square metres in Melbourne for 56 in Beijing or 108 in Mumbai?
Yeah. Would you go?
Not a chance.
No. Well, so why do you? That's why I think there's a premium for that.
Yeah. Yeah. I hadn't thought about that.
Are you going to go to Cape Town and have
No.
come on, man.
No way.
These are all these intangible things that I think we need to look at. Look, it is what it is. I want to move on to the next one. And look, I think there could be a way to go here, but interest rates rising, I don't think they're going to rise as much as everybody thinks they're going to rise. I think maybe the Reserve Bank, the Federal Reserve does push the gas too quickly and too hard. There is a risk of that happening. But again, remember, we are only at the beginning of the tightening cycle. We haven't even peaked, right? So I think there's still...
We haven't even started here in Australia.
No, we haven't started here in
Australia
yet. So I think that will take a bit of the gas out of all of this. But I don't know. I fundamentally believe there is a shortage and not enough supply.
You might be able to get another 5 square metres for $1 million in Melbourne. You're lucky.
Maybe we'll drop down to 89. The other thing that I found really fascinating, NFTs, jets, wine, watches, and the hottest luxury investments of the year by Knight Frank. This is let's get this table up now. It's their luxury investment index. And what it looks at is prime property in the Gold Coast, in Sydney, in Melbourne, in Brisbane, in Perth. Is there prime property in Perth? Shout out to all of our friends in Perth. And Australian prime property as an index. And there's a whole bunch of other assets in there: wine and watches, art, coins, rare whiskey, handbags, cars, jewellery, coloured diamonds and furniture. And then in the second column, they've got the 2020-21 annual change, so the 1 year change and the rank, and also the 10-year change from 2011 to 2021. The things that stood out for me was how little the prime residential index rose relative to that of a broader residential property index.
Yep.
As well as a increase from 2011 to 2021. I'd say most residential it wouldn't surprise me if most residential properties doubled.
Yeah.
Here, it's done half that.
Yep.
We spoke to a client today who sold a property circa $5 million. And, they were saying, it didn't, during our time, we only didn't go up as much. And I think, that's anecdotal, but it really speaks to the fact that there's yet to a certain point where those percentage rises aren't, 100%, 75%, etc.
Yep.
But the thing that stood out for me was, why do you think rare whiskey is up 428% over the last 10 years?
I don't know, man. It's rare. I got no idea. That was shocking. But is it that, I remember listening to a fund manager a little while ago, and they were saying that they had done a bunch of research, and they noticed that during times of market economic turmoil, Ferrari, Louis Vuitton, these sorts of things continue to sell really well because the wealthy just didn't care, just didn't matter.
Yes.
Because they got that much money, they can still afford to buy their Ferrari.
Yes.
So I wonder if it kind of falls into that basket, whereas it just doesn't matter. We've got the money, we'll just buy it because the price is what the price is.
But you look at some of these numbers, coloured diamonds went up 23% in 10 years.
I mean, that's nothing.
Who's wasting time doing these things? Furniture, cars. And look, there's an aspect of beyond the monetary value for some of these things. I think there's an aspect of...
like art, like I've got
enjoyment,
whatever, Van Gogh on my wall. Who cares if it's going up or not? But it's pretty cool.
But I also think there's some flex in it, right? Like,
I don't, by the way.
But don't you reckon there's some flex, like this car that I've got, the coloured diamonds that we have, the NFTs that I'm buying,
the watch, the handbags,
But I think, like, to me, I look at this. Are these some of the best investment decisions you can make? Shit, no.
No.
I would have probably drank the rare whiskey before it even saw 10 years. So, like, I wouldn't even been able to monetize the damn thing.
Yeah, I mean, look at whiskey versus wine. Like, wine's 137 over 10 years, whiskey 428. There's a huge difference. So it's not an alcohol thing, it's a whiskey specific. So maybe it's just become more popular. I don't know.
And I think with people talking about NFTs and crypto and whatnot, you look at some of these things, you throw that in the basket. Yes, there will be some massive winners out of those, but also how many tech companies started during the tech bubble and how many are actually left, right? So there's going to be a ton that absolutely fail and nothing happens with.
Yep.
But I don't think you're going to have those massive winners unless you have the sheer flooding of businesses trying to make a dollar out of it, right?
Well, and they do, right? I mean, every time something new comes along, something goes up in value, you get all these people coming in trying to replicate that, and that's right. It's often too late at that point.
Let's skip the next one. I reckon we'll just jump straight to what we've been talking about, which is infrastructure in a rising yield environment.
Yeah, so this is something that I've been reading more and more about. You've probably seen it. So the narrative is that during times of rising inflation and therefore rising interest rates, infrastructure assets tend to do better.
Why is that?
So the reason being, let's take transurban toll roads as an example. So big infrastructure asset, they've got their tolls. In their contract, they are able to and will increase their prices by X% every single year. Now, whether that's a stated percent or an inflation plus 1%, 2%, whatever that number is, but they can increase. So it's a regulated increase. They can do it every year. Gas companies, electricity, the whole lot. So for that reason, they are a natural or lend themselves to being a bit of an inflation hedge. So if inflation's at 3% and they can rise, increase prices by inflation plus 2, then they're always growing their real economic profits or real economic revenue over and above inflation. So that's the theory. Infrastructure and property are often thrown in together, but we were having a look at some charts earlier today, and it was really interesting that during times of sharp, rapid interest rate increases, infrastructure will do well for a period of time, but as soon as that sort of rolls over and those interest rate increases start to fall, and typically that's at a top of a market and the market then tends to fall, or an economic correction, they tend to underperform. They tend to kind of fall back during benign times of no real inflation, no real interest rate. They tend to not do a lot until they get to that next cyclical point of interest rates going up again. Then, they kind of
So
shoot
why
up
do
again.
people invest in? Is it a cash flow thing? Is it a hedge? Is it all of the above? Like, what is it? Why do people do these? Why do people invest in
sold as a
infrastructure?
hedge.
Right.
I mean, it's sold as a hedge for hedging against inflation, and we're seeing it promoted now. So,
but isn't real estate also a hedge against inflation to the extent that your tenant, have natural or CPI increases at renewals?
I think
every year,
depending on the property.
Sure. Okay.
Commercial, industrial, retail, residential. It's usually fixed and all the rest of it. So, yeah, I think it is.
But also with property, as rates rise, the capital value starts to come down.
Well, yeah, that's right.
And so there's this...
Presumably it will for infrastructure too, if you're using the same sort of discount methodology. What was I going to say? So, yeah, it's property's definitely and always touted as an inflationary hedge, but infrastructure, it kind of comes in and out. I mean, it's a good diversifier in some regard.
When we were looking at this, right?
Correlates to property pretty well.
It correlates very highly with property, but also what we found was that there was no long-term outperformance.
Relative to property.
To property,
yep.
No long-term outperformance. That's the first thing. Second thing is that we're trying to... And the return is persistent to the extent that we found that infrastructure does well during rate rise periods.
Yes.
But what we also looked at is how long do rate rises periods last? And so I feel like people are trying to hedge against this event that happens, one every 5 years, and it doesn't even last that long either. And so why are we going down that path, trying to hedge something for such a short period of time, whilst for 3 out of the 4 years or 4 out of 5 years, we could be participating in assets that are growing significantly in value beyond that of infrastructure.
Yeah.
And we found that over long periods of time, infrastructure does kind of what
property
does.
And I think it also depends on where that money's coming from. So maybe, like with property, you've got people going in for different reasons. Some are going in for income, some are going in for capital growth, some are going in for an inflation hedge or a relative value type play. I think infrastructure is the same. They, in theory, as interest rates are going up, then they're often quite leveraged assets. So their costs are going up, or their borrowing costs are going up, while they're able to push their prices up. And do you get a real benefit? Maybe not.
Do you think enough investors look at these things, or do they just get the sales pitch and that anecdotally that makes sense?
Yeah, I think it's a sales pitch. I mean, because it does work, right? I mean, if I show you a snapshot of this during this period, inflation did this, interest rates did this, infrastructure did this, and Australian shares did this. You go, okay, well, it works. It does. But zoom out 10 years and you go, oh, actually, no, I'm probably worse off.
And so maybe it does work if you want to take a short-term punt going, well, we got rates rising, let's get into infrastructure.
Yeah.
Let's get out of infrastructure at the top, because then when rates start coming down, you've got a massive tailwind for property, and you see property start rallying, as we've seen over the course of the last 15 years.
But the key is knowing the top and knowing the bottom, as we've talked so many times, right? So
that's the challenge.
If you know the top, then absolutely. But I think guarantee you don't.
There's more you could probably do than just sell out of your infrastructure fund if you knew that was the top.
Exactly right. So look, really interesting. Again, that promotion versus what's the really reality over a long period of time, and is so often the case, doesn't quite.
Do you feel like also it's like another subcategory or a sub asset class that we've ring fenced so that we've got specialists in it and people can just sell stuff to people?
Yeah, I do. And I also think there's a difference between unlisted and listed, as with property as well. We saw that the listed property was so volatile. It's up and it's down. Infrastructure was less volatile over periods of big economic uncertainty and turmoil.
But it underperforms constantly.
But it underperforms outside of those periods, right?
And until you've got a rate rise.
In normal periods, like normal times, which is the majority of the time. So I think, and I've always kind of viewed infrastructure and property in the same sort of basket. And those returns kind of prove, that's right. Maybe it's a a slightly less volatile trip with infrastructure, but you kind of end up at the same point over longer periods of time. But there will be periods of pretty reasonable underperformance and short periods of outperformance.
And I wonder whether investors could let that ride for 10 or 12 or 15 years where you have underperformance consistently year after year after year. My guess is people pull the pin.
We saw, was it post-GFC, pre-COVID, that almost entire period of underperformance
15 years.
Based on the index we were looking at.
Of underperformance,
as long as you know why you're going in there, and that continues to be the case, then you should be able to ride it out. But as we've seen so many times, people can't, so they'll jump in and out and lose all that opportunity. All right,
let's jump on the next one.
Okay, so next one. This is yet another article by Bloomberg. Maybe Bloomberg should be sponsoring us. We tend to reference them a lot.
I just think they've got bloody good coverage, like
they do,
global coverage, and the stories are just.
They've got people everywhere. I mean, their terminals are just. There's just so much information.
We love our Bloomberg. If you are looking for marketing and advertising,
come on down.
We hit 100 subscribers on our YouTube channel last week, so we are open for business.
All right, so company profits beat best year since 1950. Again, this is US data, so. We'll bring up this chart in a second. So the headline is profits soar as US corporates have best year since 1950. New data shows earnings jumped 35% in 2021, while workers got an 11% bump. So this chart here, which we'll bring up now, profit margin for non-financial corporate businesses after tax. So your net profit margin. Last year, US businesses posted its fastest profit growth since 1950. And when I saw this, I almost wondered whether they misprinted it because it was quite a spike. I mean, look at just the size of that move is ridiculous. But maybe it's all relative to where we're coming from. So 2020, profits are depressed, no one's buying stuff, very quickly turns around. You don't have to, you've furloughed workers or you've put them off, you've got government incentives, you've got margin expansion, all of these sorts of things, people staying at home, tons of government money floating around, sales go crazy.
But isn't it also just a reflection of what's been going on? Like we've seen earnings so US, we were looking at this this morning as well. US S&P 500 EPS is at record levels.
Yep.
And the key driver of that was margin
expansion. Yeah.
Margin expansion.
And I wonder if the supply chain issues have actually helped in a weird way. So we can't get as much stock as we want, so we're going to bump up the price of the stuff that we've already got. And that obviously helps for that margin expansion. And
people are prepared to pay for it. And we've seen it, we talked about it in numerous episodes before. We talked about Nike last time. Everyone's talking about inflationary pressures, yet companies continue to post stellar returns, stellar new high profits, and their earnings are they're hitting record earnings.
Yeah.
And what we haven't seen, JP Morgan did their guide to markets recently and having a look at S&P 500, when we see huge margin expansions like this, I mean, we haven't seen it to this extent in the past, but when you have large profit increases and margin expansion, what happens typically, you can't keep that up.
No.
And so margins start to compress.
Yep.
And I mean, it doesn't mean profits fall, maybe it does, but that starts to decline and you just can't keep up at that pace.
Make hay while the sun shines, right? Get out there and boost them while you can. And everyone's expecting prices to go up. So I guess this is the time to increase your margins where you can.
So you said while workers got an 11% bump. So we were talking about that last week. And I said, remember I said
that's right. And
it was about 10.5% increase. Because there's that second chart now. So what's that? Employee.
Go ahead.
Employee compensation share. We've got this sorted, haven't we?
Yeah.
Share of gross value added by non-financial corporations. After a pandemic spike, the share of output that goes to workers is back where it was in 2019. That's interesting.
That is interesting.
So the share that goes to workers is back to where it was in 2019.
So that's out of all sales, the percent that represents wages.
So
and bonuses, I presume.
right, as a percentage, but it doesn't. So you can see the massive spike, right, during COVID.
Yeah.
Is that because profits fell significantly, and then you've got, as a percentage, you've got compensation to employees higher. Now you've got wage increases, and you've got increases, margin expansion, and so you go back to where you were in 2019. Doesn't that logically make sense? If you carve out that massive spike,
Yep.
doesn't that kind of make sense?
So essentially, you've got wages going up a little, sales going up an enormous amount, and therefore profits, because margins have expanded, and that's why you've got this big spike or big drop back from where it was.
Because from before you had profit, you had earnings to
Were
nothing.
Depressed.
Correct, and that's why
And your wage base is a fixed amount for a period of time.
right.
Get rid of a bunch of people, sales
right.
go up. Yeah, no.
So is this an indication of normalisation? Are we normalising here, Matt?
I don't know, but look pre-2000. So
Well, yeah.
I mean, so the spike was almost back to where was that mid-range of normal. I don't know.
I don't know what happened in the early 2000s where you had, I don't know, maybe it's experienced baby boomers that were getting
out.
paid more and they've dropped
Retired,
out.
and
During the GFC, we saw people, their retirement be fast forward and go, well, that's it. I've retired. And even the pandemic also.
Yeah.
But I wonder if that's got anything to do with it. I don't know. I'm literally shooting the wind right now. I've got no idea, but to me that makes sense.
Yeah, it doesn't seem out of the ordinary. We'll try and work out what's going on there.
Let's jump on to director's cuts. The first one I want to talk about, we chatted about this last week, and interestingly, Apple came out with this the other day. We were talking about whether or not the whole work from home, the office thing, is that permanent?
How many days a week?
Is there an end? What was it? What we titled the end of an office era.
Yes.
And ironically, this is a headline again from our good friends at Bloomberg. Apple makes it easy to work remotely unless you work for Apple. The company's relatively inflexible remote work policies are inspiring some employees to look elsewhere. So Apple go on to say, employees are, this is in a memo to Apple employees, are required back in the office at least once a week by April the 11th, so next week, twice a week by the end of the month, and on Monday, Tuesdays and Thursdays by May 23. So basically in 6 weeks' time, they're in there 3 days a week. All of them are eligible for an extra month of remote work annually. And I think this was Tim Cook, quote, "We have an opportunity to combine the best of what we have learned about working remotely with the irreplaceable benefits of in-person collaboration." What do you think about this?
I find it interesting, and Apple, you would think, is a pretty collaborative, try and be innovative company. There's a lot of working, and we find it that in-person working in a team is so much easier. It flows a lot better in person. So someone like a Apple software, hardware developer and seller, it kind of makes sense that they'd be pushing that. And what I find really interesting though is Apple just went through a big payment, a bonus payment for all their employees to try and retain them. And yet this would seem to suggest that maybe they don't want the money, maybe they want work flexibility.
Interesting, isn't it?
Yeah, really interesting. So that'll be one to watch, see if the other big tech, Google, Amazon, Facebook, etc., if they follow. But
Netflix came out a long time ago. They were trying to get people back into the office. I think this is extreme, man. These people are working every day at home. Like every day. So what Tim Cook...
7 days every day? No, 5 days every day.
What are you talking about, 7?
Well, every day.
5 days. Every working day, they're working at home.
But the US, I wonder what the norm is over there in the US. Like here, I would say 3 days a week is the norm. But maybe it's not over there. Maybe the competition for employees is
staff
so hot.
are pissed.
Yeah.
So there's including 7,500 of Apple's 165,000 employees who belong to a Slack room dedicated to advocating for remote work. It was bruising. Quote, "They're trolling us, right? Others are calling it distasteful and insulting."
Wow.
The underlying message: Apple knows corporate employees using its products as tools can capably work from home. So why can't its own staff?
Well, it's a fair point.
So what are they going to do
I
with
don't
their
know if
massive campus in where is it?
Cupertino.
Cupertino. Have you seen that campus?
Yeah, it's crazy.
It looks
The
like
donut,
something
right?
that from space. Looks insane.
Could be. Who knows?
So look, I thought that was interesting. My feeling is, I reckon employers want more collaboration. I don't think anyone's saying everyone has to go and you have to work from the office every day.
Sure.
But I think we are going to move back to this
Hybrid.
3 to 4 days office.
Yeah.
That's my feel.
I think most people probably expect that to happen.
Yeah.
But they'll resist it as long as they can. All right. I'm going to jump down to this one, which is a bit of a bugbear for most people. So how gas prices compare around the world. I found this one from Statista, which was fascinating because I've got family that live in the US, and every time I'm over there, they're whinging about petrol prices.
Per gallon.
And I'm like always trying to work out the
How
gallon
much is
to
that?
litre conversion and the Aussie to US dollar. I'm
Guys,
like,
you're paying 90 cents a litre.
blow
It's
my
like,
head
shut
open.
up.
Yeah, exactly right. So I saw this and someone has done it for me, which is awesome. So this is the price of 1 gallon of gasoline or petrol by country territory as of March 28, 2022 in US dollars. So you can see here on this chart, so the yellow is very cheap. The bright red is extremely expensive. And we're not bright red, but we're pretty damn close. New Zealand is one of the more expensive places in the world.
Look at Europe.
As is most of Europe.
Why is... okay.
Yeah.
Russia.
Well, yeah, that kind of doesn't help, right? Russia, a lot of the oil producing states, in South America, Africa, Middle East.
So are we on
etc.
par with the US?
No. So the US are orange. So they're like, there's a quote here.
Orange,
so
right.
even if as a gas price of around $4.60 a gallon on average, Americans are still paying much less to fill up their cars than people in many industrialized nations, including other car-based economies like Brazil, Australia, or South Africa. All three nations were already paying between $5.48 and $5.86 a gallon. So that's, what's that, 80 cents? So what about 25-30% more than what the Yanks are paying? Europe has some of the highest gasoline prices in the world. Most of Western Europe is paying upwards of $6 a gallon as of March 28. Some of the highest prices being charged in the Netherlands, Finland, Germany, Denmark, and Norway. Germany, one of the most expensive major European economies, where they're paying about $8.60 a gallon.
Don't they have electric cars?
They got a lot.
What are the Germans doing?
Finland have a lot of electric cars.
Aren't they on scooters or something?
Don't know. Norway produce a lot of oil. That's their sovereign wealth funds basically built off selling oil. But they've still got one of the highest. So unlike the Middle East and Russia where they subsidise heavily because they produce so much of it, Norway actually taxes it quite a bit, which goes to the greater good.
What do you think about oil? What do you think about this as it relates to fueling cars?
Well, I think, as I said earlier, petrol prices dropped 15% and oil's dropped about 25%. And the government's come out and tried to cut tax on, in there as well. Look, I don't think oil price, I think we all know this, the petrol price isn't going back to where it was 6 months ago. I don't think we'll see a dollar.
I
don't think we'll get back down to $1.30. I think that's gone. I think maybe $1.50, 45.
How much was it before all this happened? What was
like
petrol?
$1.30.
Okay.
I remember in COVID, it got almost under $1. It didn't quite get there, but it was hanging around like $1 a litre.
Even though the price of oil was negative.
Yeah, you couldn't go out and get it.
The petrol station should have been paying you
right?
to fill up the fuel and drive out of the servo.
$1.20 discount for your diesel.
Diesel.
So I think what that means is petrol prices staying high. It'll flow through to inflation, and if you want cheap petrol, then you live in Russia or the Middle East, and maybe that's a trade-off: cheap petrol with freedoms or whatever it is.
I think what Australia needs to do is start investing in charging stations, superchargers around the country. I think that'll help boost electric vehicle sales. But then again, there's people that talk about Look, I don't know the details. Topic for another day. But what happens with batteries? Like, how long do they last?
How long do they last?
The minerals that go into batteries. I mean, they're going to come from somewhere.
Yeah.
Right. So there's like, I feel like it's a bit of a.
That'll be the next. I wonder if that'll be the next industry, is recycling those batteries. Like, is there a way to harvest some of that material that's in there?
There has to be.
Surely.
It has to be.
But yeah, it makes me want to buy an electric car faster than I
maybe
really
start
want
with
to.
a scooter and zip around town and see what it's like. Let's jump into tips and recommendations. What do you got for us today?
So I got a cop out because I was somewhat ill prepared. So I played golf during the week at a golf course down at Cape Shank, the RSCV Cape Shank. And the first time I played down there, so I do love playing golf. I don't get out very often. I have kids and a job, apparently. But I was really impressed at the course. It was challenging.
Did you like it?
It was fun. Yeah, like I love a course that makes you think. Like, you can't just rock up to the tee and just hit and off you go. Like, I want to be challenged. I want to get onto a green, and I want there to be movement and have to think about it, and those sorts of things. There were tons of bunkers around some of those greens. But it was a lot of fun, and I've played Metro. That's probably the best course I played, but this was pretty close. This is really enjoyable. It wasn't too difficult. I was surprised it wasn't more narrow. I was kind of expecting the way some of the guys were talking it up. I thought I was in all sorts of trouble, but for the most part, managed to stay on the fairway. But it was. I think it was a good mix of challenging, but a little bit forgiving at times where it needed to be.
I think it was.
So I really liked it. It's a public course. You reliably informed me. I didn't realise that. I thought it was for RSCB members only. But no. So look, if you're looking for a really good golf course, you can even take the wife, husband, boyfriend, girlfriend, whatever, down there, stay at the resort.
It's good, man.
Yeah, just a nice setup. And it's just a beautiful location too. Like, absolutely stunning.
The one in Torquay is really good. Like, I remember we went there a few years ago. I had a conference there, and then my wife came like the next day, and we went newborn at the time. They got kids stuff and pool and whatever. And it's good fun. Like,
that was really good.
The course is excellent. I agree with you.
Really enjoyed it.
I've got this rule that I don't like watching movies that are, I like watching the old classics, but anything that's older than like 2017, 18, like, nah.
Well, that's 5 years ago.
Yeah, I know. Yeah. We talk about 2019, like, it just feels like so long ago. Don't you reckon? 2019?
It's been a tough couple of years. Like, it's been a long couple of years.
Admittingly, I know there haven't been many movies released after then because of COVID.
So what do you got?
So I bit the bullet and I watched Sleepless with Jamie Foxx. Have you seen it?
No, I haven't seen
it. He's a cop. He gets caught up. He gets caught up. His internal intelligence, or whatever internal bureau is in the academy, and they go on this drug bust, and his partner takes drugs from this drug lord. His son gets kidnapped, and then he's on this mission of this one guy trying to take down this whole mob in a casino that the guy runs. That was okay.
Plenty of action.
There's a ton of action.
Yeah.
But it's one of those movies where you think, that's just ridiculous.
Yeah,
this guy has got into like 15 fights in the casino by himself, and he still manages it to like stand up and, fight the next war.
Yeah.
So look, if you're bored one night, it's a good movie.
Willing suspension, right? Of
6 out of 10.
6 out of 10?
Yeah, 6 out of 10. What have we got?
What did Google gave it a 73, or Google ratings. Rotten Tomatoes 25%.
Yeah.
IMDb 5.6.
I rely more on IMDb.
All right, 5.6 out of 10.
And it wasn't.
You liked it better than.
Look, Rotten Tomatoes is ridiculous. I don't even know why that's even being published these days. IMDb, I would rely on IMDb and Google. I didn't even know what the scoring was. I ended up between IMDb and Google. It was a $30 million movie. That doesn't sound like a lot of money for a movie, is it?
These days. But it was 5 years ago. That's a long time. Inflation.
Inflation has ripped higher since then. And it was only an hour and a half.
I wonder what it raked in the box office. I'll have a quick look here. Film grossed $33 million against a budget of 30. I think maybe that's all you need to know.
There you go. Just look at
All right, I'll give it a whirl.
All right, hit us up. We didn't get a chance to respond to some emails that are sitting there. So if you're listening, guys, we will get to them.
Drop us a line.
We promise you.
Say
But any more questions, hit us up at info@baharianwealth.com.au and we'll catch you next week.
Cheers, guys.